So today, we're going to talk about how you can tell what your money is actually growing by in a whole life insurance policy. When it comes to whole life insurance, a big problem that has gone on for a very long time is that people often think they are getting something that they're not. You ever feel like that? I'll give you two examples. If I said, you can put your money in this whole life insurance policy, and the insurance company is paying you a 6% dividend, what do you naturally think your cash value is going to grow by? 6%. That's what most people think. Another example. If I said your cash value grew by $10,000 this year, last year it was $20,000, then this year it was $30,000, it grew by $10,000. That's even what the insurance company illustration says. But then you say, but I paid $8,000. That counts as my growth? I would say no, it doesn't. The actual growth is $2,000 in that example. Then we also have all of these different terms. If you asked, what's my rate of return? Well, I've got the dividend interest rate, I've got the annual rate of return, I've got the internal rate of return. If you wanted to know what your cash value grew by in terms of dollars, you've got the year-to-year cash value growth, and then the total cash value gain. It can be overwhelming and confusing to a lot of people, and we've seen and heard people say, forget it, it's too confusing, I'll just do something else with my money. So why is this a problem? Well, to give you the answer why life insurance is marketed in certain ways and why terms are used in certain ways, I don't have that answer. However, what I can do is attempt to make everything as transparent as possible, which is what we will cover in today's video. What we'll cover are two things. First, we'll look at a life insurance illustration, and I'll go over how you can track your cash value growth in terms of dollars. And then second, we'll look at the actual growth rate in terms of percentages. And here's the big item to be aware of. When you look at an insurance product, percentages are always gross. They're not net. Keep that in mind. We are going to break things down and make it as transparent as possible. Let's begin with the life insurance illustration. Here we've got an illustration, a 30-year-old individual paying into a life insurance policy with a major mutual company here. He's paying $10,000 per year for 10 years. Okay, so we've got these different columns. First, we've got annual net outlay. That is how much you pay every year. So annual outlay represents the yearly payment. Then we have cumulative net outlay. This tallies up all of your annual payments. For example, 2 years into it, you've paid $10,000 twice, so your total payments are $20,000. 10 years into it, you've paid $10,000 for 10 years. Your total payments are $100,000. You pay nothing after year 10 in this example. That is why your total payments do not exceed $100,000. Then we have net cash value. That's easy. That's your money column. Then we have net cash value annual increase. So when you see this column, what do you think of? I think this is what my money is growing by each year. The first year, your cash value is $8,500. Does that mean your cash value increased by $8,500? I don't really agree with the way this is displayed. I get what the insurance company is doing, but here's what I don't really like. And a lot of people sometimes feel confused with this too. You paid $10,000. You have $8,500. That means you have $1,500 less than what you paid in. I would prefer to see negative $1,500 there. This way, I can take into consideration what I'm paying into the policy each year. We'll break that down a little bit more as we continue. And then the far right is the net death benefit that's paid out when I die. Death benefit proceeds are always paid out 100% income tax-free to my beneficiaries. Okay, so we're going to reference this illustration several times throughout this video. let's break down illustrations and just how the cash value grows. So show me the money, meaning show me what my cash value is growing by on a yearly basis. We'll start with just 1 year. So simply, I want to know, what is my cash value growing by this particular year? Okay, let's say that last year you had a life insurance policy and you had a nice amount of money in cash value. You had $85,000. This year, you paid $10,000. Now you have $100,000. Here's the question. How much did you get from the insurance company over the past year? So only last year, how much did you get from them? Is it A, $15,000 because it was $85,000 and now it's $100,000? Or is it B, $5,000? The answer is B, $5,000. What we want to account for is the fact that this $10,000 you added, that's not money you get from the insurance company. That's money you added to your policy. It all showed up in cash value, which is fantastic, but then what you actually got from the insurance company is everything above that. Think of it this way. If you had $85,000 in cash value and added $10,000, now you're at $95,000. But then, if you see $100,000 at the end of the year, that means the insurance company gave you another $5,000. Let's look at an example, and we'll look at this policy, but we'll look at a different version of it. When I say different version, I've just got it on Excel. Okay, so here we go. This is the exact same policy. So if we just look at year 1, you pay $10,000. Your cash value is $8,500. Here we've got gross yearly cash value growth. This is that same column we just saw in the illustration, which read $8,500. However, what I would prefer to see is this, because it highlights the major drawback to whole life insurance, which is the first year. It's always the worst year. I don't want to have someone feel like I'm trying to hide that. No. What's the drawback to this? It's really the upfront hit. So I got less back than what I paid in. The second year, you paid in $10,000. If you add $10,000 to $8,500, what would you have? $18,500. Yet, you had less than that in the second year. So you did not get the full $10,000 back. You took another hit this year of $643. Then each year thereafter, why the net yearly cash value growth is positive is because you're getting more back than what you're paying. Now, if you feel like this is confusing, one thing you can look at is year 11 after you stop paying, and here's why. Because when you don't have any payments going in, this is way easier to track. Your out-of-pocket is 0. Your cash value is 117, grew to 123. There's the gross cash value growth. We don't have to factor in any payments here. And there's the net. They're exactly the same. You'll even see that on the life insurance illustration from the insurance company, that it is exactly the same. Look at that. After you stop making payments, that net cash value increase represents only what you're getting from the insurance company. So when looking at the year-to-year cash value growth, I want to see specifically what am I getting from the insurance company. So that's how we measure the year-to-year growth. Let's talk about how to measure the total growth. So if we take that same life insurance policy and look at it over a 10-year period, let's pretend that you pay $10,000 per year every year for 10 years. That's a total out-of-pocket of $100,000. If you have $100,000 in cash value, what did you get from the insurance company over 10 years? You paid 100, have 100. That means you got 0. At this point in time, you've only gotten your money back. Not that attractive. Now, you should have a gain 10 years into it, especially if the policy is set up correctly. So what if you have that same policy, you paid $10,000 every year for 10 years, total of $100,000, and now you have $120,000 in cash value. How much did you get from the insurance company over that 10-year period? The answer, $20,000. How you can measure the total gain on life insurance policy, if you're asking your agent, how much did I get from the insurance company? Like, what's the total amount I've received since I started this policy, what you would do is take your cash value minus the total amount of money you've paid, and the difference is the gain. For example, here, we assumed you have $120,000 in cash value. You paid $100,000, so that $120 minus the $100 you paid gives you the $20,000 gain. Let's look at the same policy we've been looking at and see what the gain is. So we won't see it here on the illustration. We can calculate it. Look at this. By year 10, you've paid in $100,000. You have $117,522. What would the gain be? $17,522, the difference between that and your total payments. But to make it easy, we'll do this. Much better. Now we can just look at everything side by side. So what we've got here, exact same illustration, but notice this column does not show the year-to-year cash value growth. It's the total gain. So for the first 4 years, you are in the red. Even though in year 4, the cash value grew by more than what you paid in, you still don't have a gain yet because we're making up for that first year. So it's negative $897, and where that comes from is the fact that in year 4, you've paid a total of $40,000 and you've got $39,103. Take the difference there, guess what it gives you? $897. Year 5 is highlighted in yellow because that's the first year we have more in cash value than what we've paid. This is referred to as our break even, or when we get our money back. But the cash value gain will tell you that, which is very nice. So again, the cash value gain is just looking at what do I have in cash value minus my total payments, and the difference is my gain. If I look at it at year 20, you're at $91,000, almost $92,000. So it does get better with time. You'll always see that with a whole life insurance policy, even if it's designed poorly, which we wouldn't recommend, but you will see it produce a gain over time. Okay, let's talk about rate of return, because this is always a hot topic, a question I've heard time and time over the years and will continue to hear is, what is my rate of return? What did I earn on my policy last year? That's what I want to know. So when it comes to the rate of return on a life insurance policy, I can tell you what it is not, or what will not give you a transparent number. The dividend rate, unfortunately. So the dividend rate is not what your money is going to grow by. A quick example. Let's say you have $10,000 in cash value. You have a 6% dividend rate. How much should your money grow by? Well, common sense would tell you and me that if I have $10,000 in value and I'm earning 6%, that's $600. Here's where the problem happens in this business. People look at that and think that's what they're going to earn. But then you look at your statement or you look at your cash value and you only got $400. How do you feel? Not that good. That's 4%. You said 6%, or that's what the insurance company told me. I feel like I got robbed. I'm confused. What's going on? You ever feel like that with a policy or anything? It's not a good feeling. No, I do not like feeling like that at all. Setting expectations up front are extremely critical in order to prevent it, or setting expectations properly. Transparency, that's the key. The thing is, the net growth rate is going to be closer to 4%. It'll be somewhere between 4 and 5%. We're going to look at that same policy again in a minute. So when we look at insurance products, what I want to be aware of is that percentages are always gross, not net. Think of it from the insurance company's perspective. They're going to say, we're giving you this insurance product. It will produce a positive cash value over time. However, we are going to have a cost of insurance within the policy. So you still have to pay for the insurance, and that's always there. So they'll say, here's your dividend rate, but also you're buying a life insurance policy. So what we want to do is take the gross rate, subtract the cost of insurance, and then we'll have the net rate. But also remember here, it's tax-free. which there's a huge benefit, tax-free if you do everything right with a life insurance policy. But that can make a lower return much more attractive, especially if I am in a high tax bracket. So terms you'll want to know in order to get the net rates with a life insurance policy, the net growth rate. 1, annual rate of return. 2, internal rate of return. Let's look at the annual rate of return first. This is the easier to calculate of the two. We'll look at a new policy, and then we'll look at an old policy, and it will all be the same policy. So let's pretend you start a brand new policy. It'll be the one we just looked at. You have a 6% dividend rate. You start before you pay anything into the product with 0 in cash value. You pay $10,000. You have $8,500 now in cash value. What is your annual rate of return? So percentages are what we're talking about here. Is it 6%, the dividend rate? Is it 0%? Or is it negative 15%? The answer is negative 15%. Here's how we can tell. So what's nice about this, before we look at it on Excel, let's look at it on the illustration, as we can go down to the actual percentages, where the illustration is going to call it 1-year rate of return. So here's the first year return, negative 15% on the life insurance company's illustration. So that's year 1, that's our annual rate of return. Year 2, negative 3.47, but we see it increasing over time. We see year 11, when you pay nothing in, it's 4.84%. Where that comes from is year 10, you had 117,522. You paid 0. The growth was 56.84. That comes to 4.84%, which gives you the 123 and change. We can do the same thing on Excel, which I actually prefer because I like to add some colors to it. It helps me follow things quite a bit. But here we go. We've got the annual rate of return, which is nice. And this one peaks at about 5.15%, which is very attractive. But remember, the dividend rate, with this example, it's actually 6.1%, so a little bit higher than 6%. Regardless, we never see it hit 6%. But the annual rate of return just shows us what the policy is growing by year. So to follow up on what we just looked at, let's say you have an old policy. You have $100,000 in cash value. You pay 0. Now you have $105,000 in cash value. What is your annual rate of return? What did you earn that specific year? 6%? The dividend rate? 5%? Or I don't know, which is okay if you feel like that. I know this can be confusing. The answer is 5%. Because you had 100, 5% of 100,000 is $5,000, which is how we came up with the 105. Let's look at the internal rate of return, and we will wrap up with this. So internal rate of return can be a little bit more confusing. I'm not going to get into the definition of internal rate of return in this video. We're going to go through an example. If you paid $10,000 per year, every year for 10 years, and at the 10th year, you have $115,000, what is your return? 15%, 2.5%, or 5%, specifically your internal rate of return. Had 100, you paid in a total of 100, now you have 115. That's a $15,000 gain. Do you think it's 15%? It's not. It's about 2.5%. The reason why is because I have to account for the $10,000 per year payments I made each year, all 10 years. If I had $100,000 and the next year it was worth $115,000, if I just earned 15% in 1 year, then I would have a 15% annual rate of return. However, when I look at a life insurance policy, that's not the case. If you've got experience with real estate, you might be able to relate to this a little bit more. I know real estate investors will frequently use internal rate of return. Let's look at an example of this. We'll look at the illustration, and then we'll also look at Excel here, because you can request this from the insurance company, which is nice. IRR on cash value. Exact same illustration we've been looking at here. What do you notice? First year, 15%. Year 10, 2.92%. We've got 117 and change in cash value though. So we've got our handy dandy IRR calculator here. Well, first, let's look at the Excel workbook. There we go. There's the illustration we've looked at every time. Notice 4 years, when you have less in cash value than what you've paid in, you're in the red. After that, you're positive. IRR calculator. Let's make year 10 $115,000. IRR would be just about 2.53%. We've got the annual rate of return and internal rate of return here. A lot of stuff. I know this is a lot. The purpose of this is really just to show you how you can get true numbers with a life insurance illustration. If you have a policy already, hopefully this was helpful so you can see how to crunch the actual numbers. What is my cash value growing by each year? Remember to back out your payment. We don't want to include that in the cash value growth because that's your money. What about the total cash value gain? How do you calculate that? Take your total cash value and subtract the total amount of money you've paid. You can request this from your insurance company or agent by asking for the cost basis. That is your total payments that you've made throughout the life of the policy. Then we've got returns, annual rate of return. How do we calculate that? That's pretty simple. What was my cash value last year? What is it this year? Make sure that I include any payments, and I'll see my net return. I can look at it on Excel, and usually the life insurance company does have an option where it can be included in my illustration as well. And then the internal rate of return, I would recommend always doing that on Excel or requesting it from the insurance company so you've got it on their literature, because that formula can be more complex. So I do hope that this video was helpful. Let us know if you have any questions at all. If you'd like to see a video where we talk about the average returns, the average growth rate on a life insurance policy, you can check out this video here. And as always, I hope this helps. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.